I've done other research at PREA looking at the investment characteristics of more affordable multifamily versus, middle income and luxury multifamily. And I got to admit, I was a little surprised by the strength of the results when I put this all together. It turns out that multifamily that is more affordable actually has better risk return characteristics historically than luxury multifamily. It's a lot lower risk over the cycle because you have this giant pent up demand. Vacancy is very, very low, no matter what's going on. And over the long term, it ends up being, a better investment in terms of risk and return.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast YouTube series, Real Estate Market Watch, current events through a real estate lens. My guest today is Greg MacKinnon. I actually spoke to Greg a couple of weeks ago and he kindly agreed to come on the podcast again. Last time, we really ended up focusing on what exactly is the definition of an institutional investor. We talked about other things as well, but that was a fairly main or major focus of our conversation. So we revisited today to talk about some of the primary drivers behind the housing affordability crisis that we have here in the United States and, in fact, internationally, and how institutions are measuring risk and adjusting their strategies to accommodate that. Let me just tell you briefly about who Greg is. I'm going to read something from his bio here. Greg MacKinnon, PhD, CFA, is Director of Research at the Pension Real Estate Association, PREA, a position that he's held since 2009. He provides in-depth research, data analysis, and thought leadership on real estate investment topics to institutional investors, both domestically and internationally. He's responsible for overseeing PREA's research agenda, producing original content, and supporting members with objective, data-driven insights into investment issues and commercial real estate trends. He writes several papers, or writes papers, actually fairly frequently, or papers or articles. We talk about a couple of those in today's show, with a focus on housing. If you have not yet been to or subscribed to my newsletter, please go to GowerCrowd.com, hit the subscribe button, and you'll get detailed analytics or summaries of these conversations, as well as tips and tricks on how to best practices, actually, not really tricks, but anyway, tips and guidance on how best practices for capital formation, particularly in today's uncertain market. Okay, let's move on. Greg MacKinnon, Director of Research at the Pension Real Estate Association, coming right up. Greg, good to see you again. Thanks so much for joining me. Last time we spoke, you mentioned, it's actually a very interesting data point, how institutional investors are pondering whether to book losses suffered over the last few years or to hold out for an upside. But either way, they're frozen and relatively inactive. And I've certainly been hearing this anecdotally as well from sponsors that typically raise capital from institutional investors. The Fed has started to loosen policy, right? Basically, and it's indicated not only that they reduce rates 25 basis points, but there's a reasonably good chance that there will be more reductions in rates before the end of the year. What kind of impact is that going to have, do you think, on institutional investors? How are they viewing this in terms of their longer term perspective and this idea that the market is slightly frozen for them at the moment?
Right. Well, I mean, there's a number of different ways you can look at this. I mean, first of all, one of the things that has contributed to the market slowdown in terms of number of transactions is the cost of financing, because interest rates were higher. Obviously, if interest rates come down, that will help alleviate that little bit. And maybe there's a few deals that didn't pencil out before that maybe will now pencil out. So I think it's not I think the general sense in the market is that it's a positive, certainly not a negative. I know that for sure. I think sometimes people, and this is not just in the real estate market, I think this is in the capital markets overall and even across the economy. I think sometimes people are a little bit obsessed by what the Fed does. Here, I mean, there's no direct connection between what happens with the Fed funds rate and what happens with yields on bonds in the market. As a matter of fact, I don't know if we want to date this podcast, but
Sure,
the
no
25
problem.
basis point cut was yesterday.
Hey, no problem.
Today the
Right.
yield on the 10-year is up a little bit. Why exactly? I mean, who knows? Hard to read the tea leaves. It could be a little bit of fear about potential of increased inflation because the Fed's in a funny position. They're lowering rates because the economy is weak and the job market doesn't look good, but inflation's still above their target. If they lower too much, that could create more inflationary pressures. And that will end up with the 10-year going up. So the Fed lowering rates, it's definitely not negative. It's probably net a positive. I don't think it's that big a deal, quite honestly, on a day-to-day basis within the real estate markets. It really more depends on what's going on in the underlying markets. And I've done research, at PREA in the past, looking at the effects of interest rates on the real estate market. And
Mm,
what comes out of that is the important thing is not interest rates themselves; it's what's going on in the economy that dominates. And if
mm.
the Fed's lowering rates because the economy is getting weaker, net, that's not a good situation for real estate. So real estate and the returns to investors on real estate really depends on what's going on in the underlying economy. Interest rates are important, financing costs are important, obviously, but it's really an economic thing.
Right. And what drove this yesterday? And I actually, for the first time, watched the press conference. I've never done that before. It was really
It's
interesting.
just so exciting to hear central bankers talk.
I actually found it fascinating, but that's just my personality. But it was definitely a focus more on employment, and that, of course, speaks to all the signals that employment is beginning to weaken or demand for employment, and the contradictions in the data with fewer immigrants, more deportations, and it was just interesting to hear the contradictions, if you like, the paradox and the complexity making the decision, especially alongside the idea that, or the acknowledgement that inflation is definitely above target and unlikely to come down. But this does speak to housing, doesn't it? Very much so. I mean, it's probably the more people watch interest rates because of housing than anything else. So what is what? And you wrote this paper, Bifurcation of American Renters. So what's going on in America that's driving this the so-called housing crisis? Do you think?
What's driving the housing crisis? That's a big question. We probably
Yeah.
need about a 6 hour podcast to cover all the issues there. But I mean, there's definitely a housing crisis. There's a shortage of
Mm,
affordable housing. There's no doubt. I mean, everybody agrees on that. Everybody of every political persuasion.
mm,
It's not something that's just in San Francisco or LA or just New York. I mean, it's really across the country and quite
mm,
honestly across the Western economies. So you hear the same things in Canada and the UK and Australia. All these countries, all the developed countries, are facing this housing crisis. And essentially, it comes down to just there's not enough stuff being built. That's what it comes down to. Now, hopefully, reduced interest rates will sort of help that because it'll help some of the deals pencil out. But I don't think it's a panacea. And what you've seen in the market, and you referenced this article I did recently on the bifurcation of American renters. If you look at just renter households, so we sort of take out the ones that own their own home, and you break those down by income category. So, sort of 60 to 80% of median income, 80 to 100% of median income, 1 to 120, 120 to 140, 140 and above. So in sort of categories, depending on where they are versus the median
mm,
income. And you look at the number of households, the change in the number of renter households over the last 10 years, what you see is big increases at the extremes. So a
mm,
big increase in renter households that make 140% or more of national median income. And so basically these are people that could buy a house, right? They probably have the financial means to buy a house. Unless maybe they're, in New York and they make a lot of money, but that's a very, very expensive market.
mm,
But generally fairly well off. And the other place you see it is in the kind of moderate low income category. There's a big spike in those kind of 60 to 80% of median income. Right. So the two extremes, and in between, you're seeing a decline in the number of renters. So you're getting sort of high income renters, that
mm,
category is growing. You got lower income renters, that category is growing, and the people in the middle are sort of disappearing a little bit. So I think that has big implications for real estate investors in terms of the market you're targeting your products at. The other thing that comes out in a big way is the lowest income. This is probably one of the biggest findings. The lowest income category, so less than 60% of median income. So these are low income renters. That has, I don't like to use extreme language, but kind of fallen off a cliff. You see very, very little growth in that area at all, even though that actually is the biggest category of renters. And those are people that simply can't afford to find a place to live anymore. I mean, there's not enough product out there that is affordable to somebody that makes 60% of median income. So that's not a demand issue, it's a supply issue. If and again, this is not, these aren't necessarily these are people that are working, they have jobs, might have two incomes, but the incomes are relatively low. So it's a family, and there's just not a place to live. They can't find it. They cannot find a place that they can afford on their salaries. And that's really, I think, the crux of the matter in terms of the affordability issue in the US right now.
So what is the impact of that? And I've got to think about this. I mean, the impact I would like to talk about, but I also want to stay focused on how does that affect real estate investor decision making. But what is the impact of that? Does that mean that these, low income households, very low income, let's call them very low income households, what's happening? Are they just commuting intolerable distances to work? I mean, they're living somewhere. I mean, we know that homelessness is up. At least, I live in LA. I mean, I've seen LA. It seems like it's everywhere. But apart from pushing people actually out onto the street, they are living somewhere. So what is going on? Are they just commuting huge distances? Like what's happening?
They're not just commuting huge distances because they're actually not renting a place. So what's happening is household formation is being impinged. So in other words, you're a young family, perhaps, maybe you're married, you're both working, or maybe it's a single person working, or making money, but you're still sort of less than 60% of median income. You just can't move out on your own. So maybe you're in your parents' basement. Maybe you've got roommates. Maybe you've moved in with a different relative. And quite honestly, maybe you just don't have anywhere to go. I mean, and as you've noticed, there's some cities in the US where there's just people that literally have no place to go. So I think there's a number of different things that are going on there, but the key idea is there's just not enough space and enough units, at an affordable level to house all the people that would like to be housed at that income level.
And that's because to produce this kind of housing, the costs have gone up too much. Land is too expensive. Interest rates have gone up, and there are no incentives. Is that right? Basically,
yeah. I mean, there are some incentives. The LIHTC program to build new affordable housing, has created a lot of units over the years. Outside of that, in recent times, because of the increase in operating costs, increased construction costs, is becoming more and more difficult. I mean, the interesting thing about it is, so the question is, how do you get capital to move into that space, to build and own properties that are designed to be affordable to a big part of the population. And I've done other research at PREA looking at the investment characteristics of more affordable multifamily versus middle income and luxury multifamily. And I got to admit, I was a little surprised by the strength of the results when I put this all together. It turns out that multifamily that is more affordable. When I say affordable, I'm not using some kind of regulatory definition. It's just affordable to people.
Less expensive, right?
Less expensive, sort of an intuitive definition of what affordable means. That actually has better risk return characteristics historically than luxury multifamily.
Really?
Yeah, and the real key thing is it's a lot lower risk over the cycle than luxury is. And if you plot these things out, basically as you go, through the economic cycle and things are good and things are bad and up and down, rents and returns to investors on luxury multifamily, they can go zooming up, they can drop like a stone when times are bad, they can go back up. So long term, they do well. I mean, it's not, I'm not thinking it's a bad investment, but it is
Mm,
volatile through the cycle. The thing about more affordable housing is because you have this giant pent up demand, like
mm,
vacancy is very, very low, no matter
mhm,
what's going on. Even if the economy is bad, typically people will cut back on spending, people will cut back on this, they'll cut back on that, they'll try to save money. The last thing they do is move out of the apartment they have.
mm.
So vacancy tends to be low. The renters tend to stay longer in these properties, and you even as the economy goes up and down, affordable housing just kind of grows on a nice slow basis. It's not way way up. You're not going to get rich if the times are good, but typically when times are bad, it still kind of creeps up a little bit. And over
So
the
do you,
long term, it ends up being a better investment in terms of risk and return.
um, so do you see do institutions specifically look for this, or like what drives their investment philosophies or processes? Are they say, okay, we want to do affordable, therefore, we're only going to look for folk like that, or do they say we need to have an 18 or whatever 15% IRR during the course, and we don't really
Right.
know what kind of housing it's, it luxury or otherwise?
Typically, what they'll do, and again, I mean, everything I always say every investor is different. There's always a different
Of
process,
course.
but I think generally speaking, if a sort of a mythical, typical investor was here, they'd say, listen, out of our overall real estate portfolio, we allocate so much to multifamily, whatever it might be, 30%, say. Within multifamily, we may allocate so much to affordable properties, so much to workforce housing, so much to luxury properties. So they want to be diversified across the different categories. So they are
Mm,
looking at now. That's changed a bit. There was not very much interest going back, I don't know, 10 years ago, anyways. There was not a lot of interest from institutional investors in affordable housing and more affordable multifamily.
mm,
Because, I mean, at the time, the idea was, well, it's kind of risky that these people are low income. What happens if they can't pay their rent and that sort of thing? I think as the data's come out and people have begun to say, hey, this is actually not only is it sort of good for society, which is great,
mm.
um, but it's actually a good investment. There's been a lot more interest. There's a growing interest in investments in the more affordable part of the multifamily market from institutional investors. So they're allocating a certain percentage of their overall multifamily portfolio to affordable strategies. And there's a number of different strategies in the sector that you could take on, whether it's LIHTC properties sort of newly built or it's buying existing properties and bringing them up to a reasonable standard in terms of putting some capex to them, but keeping the rents affordable at the same time.
So if there is, I mean, institutional capital is so vast, right? So it drives liquidity on the equity side, particularly in real estate. So if there is this focus on affordable, and if it is lower risk, uh, why is it fallen off a cliff? I mean, we've talked about some of the factors, but is it also because institutions are pulling back? That's just because that part of the market's frozen, or what's going on?
Right. I mean, well, so there is an increased interest in the affordable part of the market from institutional investors, but
Mm.
that's a relatively new phenomenon. I mean, some have been
Ah,
involved for years, but many are just starting to look at it now. So it's not like there's an overwhelming amount of capital.
ah.
The other thing, and you mentioned this a couple of minutes ago, I mean, even if someone is interested in the affordable multifamily space, you have to find the right place to actually put the money to work and put a
Mm.
building in the ground and get people in. And with operating costs, insurance costs are actually through the roof too. Insurance costs are through the roof across all property types, quite
Isn't
honestly, but
that
especially
ironic?
for
I
multifamily.
have to jump in and say the irony is that you have these insurance funds who are looking to place money, and yet they're also part of the problem in some way.
Yeah, so that's another big cost.
Mm,
So costs are up. It's becoming under current conditions, and hopefully maybe lower interest rates will help alleviate this a little bit. Under current conditions, it's sometimes hard to make these new projects pencil out. A lot of the institutional capital is most interested in preservation of affordable housing. So rather than putting up something new, and some do that, but most of the capital goes to preservation, meaning there's an existing property. We're going to come in. we're going to put some capex into it to make sure that it's a quality place for people to live, and the strategy is to keep the rents at an affordable level going forward, sort of grow them gradually with inflation or something, but not try to drive rents, and keep these properties affordable, and sort of just use it as a fairly steady way to generate returns over the years. So that's great and that's needed, but it doesn't create new affordable housing. That's
Right.
really the problem at the end. The affordable housing crisis around the world is actually, in some ways, very simple. The solution is to build more stuff. And that's all
It's
you got to do.
just, it's so obvious, isn't it? I
It
mean,
is, but there's just so many barriers to building
yeah,
new stuff. Some economic, some regulatory, some is NIMBYism.
yes,
But there's so many barriers that not enough new stuff is getting built. But there
yeah.
is an attractive investment strategy in the preserving the existing stock of affordable housing.
Well, the other reason for that, of course, is that if you buy an existing property, you're going into something that is yielding. It has a yield immediate, right? It has current yield as
Yeah,
soon as you buy it.
yeah,
Rather
you
than,
don't have the construction risk. I mean, and there's also some interesting outfits out there. Certainly, I wouldn't name names, but there's a couple in California doing
Mm.
interesting things with new technology and new construction techniques, modular construction techniques, and that sort of
Ah,
thing, to allow affordable housing to be built at a much lower cost than sort of the traditional. I mean, that when you think about traditional construction, I mean, we're using the same basic
mm.
technology that they used in Mesopotamia 4,000 years ago. Put a bunch of bricks on top of each other and build a
Right.
building. There are new ways to do it in a more
Mm.
efficient way. So there
Yes,
are
but
some really
those also have issues with finance, don't they? I mean, there's challenges getting bank finance, so it's not actually the
yes.
panacea you would like to think it is. But
No,
not
it's
you
I
would
don't think
like
there's
to
any
think of it.
single thing that's panacea. That's a panacea.
Right.
And the bank financing, and I think just even though there is an attraction amongst institutional investors to affordable housing strategies recently, there has been a decline in capital raising across the board in real estate over the last couple of years. People just aren't. Yeah, we discussed this, I think, in the last the last podcast. You know, other funds aren't giving their capital back, so the investors aren't getting the capital to put out into new ideas. So things have
Mm.
kind of slowed down to a large extent. And that means everybody's having a hard time raising capital. And if you are a relatively small person, shop
Mm.
specializing in affordable housing in California or the Southeast or something like that,
Mm.
you've got problems raising capital too, and problems raising bank capital. So,
Greg, are there any policy shifts that you're seeing that will help stimulate the market, especially on the housing side?
the their housing policies shift on an hourly basis, as I'm sure you're
I
aware,
know.
since over the last year or so.
Yeah.
I think
Yeah.
rather than say there's a specific policy shift,
Mm.
it looks like the LIHTC program is probably intact.
Just
Uh,
explain what that is briefly for the one person that
so
doesn't know what a light tech is.
yeah, and it's not the one person. At some point in the not too distant past, I had to Google what is LIHTC and
Yeah.
figure it out. So
And how it's
LIHTC, so
spelled. Right.
LIHTC is the low income housing tax credit.
Hmm.
So essentially, if you are a developer engaging in new construction, you can get this LIHTC tax credit,
Credit. Right.
credit for your construction. You have to guarantee a certain level of affordability for a certain number of years. So you might say, listen, 75% of the units in the property will be affordable to people at less than 80% of area median income, and we're going to keep it that way for the next 30 years.
Mm.
So something like that. It's done under a competitive basis, so you sort of apply, say, this is my plan. Can I get a LIHTC tax credit, please? It's run by the states, and they have so much money to give out, so they review the applications and say, okay, yes, you get it. The great thing, or one of the great things, is those LIHTC tax credits are transferable. So the developer can sort of basically sell those tax credits to a bank, for instance, for
Hmm.
cash up front to help fund the construction. So it's a way to, it's a way to facilitate both the financing and the making sure the deals can pencil out for
Hmm.
properties that are newly built and meant to be affordable and kept affordable for a a lengthy period of time.
Okay, and so in terms of policy shifts, are you seeing more of that, or is there anticipation that there will be
Yeah,
salvation in
that
some way?
yeah, there's no, as far as I know, and
Mm,
I'm not on Capitol Hill, and I'm
mm,
not an insider, but as far as I know, there are no planned changes to the LIHTC program, so it's still intact. Housing and urban developments, as far as I know,
mm.
again, things could change in an hour. No major shifts. They have been cutting back in terms of personnel. So one wonders what happens if the LIHTC pro working there anymore. That there's issues with that. If you phone for a LIHTC credit and nobody picks up at HUD, then what do you do? So
Hang on, that's
the
not trivial.
biggest issue.
Wait. So what's this? You're talking about downsizing government departments,
There was downsizing across the federal government,
right?
including at housing and urban developments, where a lot of these programs come out concerning
Mm,
affordable housing. So even if they do not change, the regulatory framework or the programs
mhm,
themselves, if staff has been reduced by, and I'm just making a number up, I don't know what the number is, but if
mm,
staff's been reduced by 50%, as an
mhm,
example, uh, there could be questions about how those programs, even if they're
mm,
officially still there, are actually being implemented. So that's a concern. I don't think it's had a major effect yet, as far as I
mm.
know, but it's certainly a concern that is out there.
Now, you mentioned the middle group. You talked about this kind of barbell, that the high
No,
income is still strong, the lower income, not the super low, but is also strong.
right.
This middle group is struggling. So just explain the dynamics of that, if you would, please. What's going on in this middle group? What exactly is this middle group?
Well, the middle group, I mean, those are the people that are right around median income. So your average, typical Americans, right? It could be a firefighter or a bank teller or a teacher or whatever. They are becoming those that middle income group, kind of,
Mm,
that often is renting what some people would call workforce housing,
hmm
right? So this is not low income housing, it's not luxury housing, it's just housing designed for the average person.
mm.
They're becoming a smaller and smaller part of the overall renter market because you're seeing this big growth at the very top end. You're seeing a growth at the sort of the moderate low income end, and you're seeing declines in that middle part as well as the very lowest income.
So what's happening to this group? Are they
Well,
moving?
I mean, you
What?
should have a sociologist on here to talk about this stuff. I mean, I think in large part it's the same sort of thing. They're getting squeezed out by the high end, and there's simply not enough. When you say affordable housing, it
Mm,
doesn't always have to be something that's deeply discounted and for the poorest people in the worst
mm,
financial conditions. Affordable can mean something that's just affordable to an average person in the market. So it could be workforce housing.
mm,
And
hmm
again, there's a lack of new construction on average across the market,
mm,
across the country. And that has led to, again, a decline in household formation over the
mm.
last 10 years of average income families. They just don't have, they can't afford to buy. Interest rates were high, house prices were up. It's hard to save money. And it's getting increasingly harder to rent. I mean, the interesting thing, I mean, I said sort of facetiously, the easy answer to affordable housing is just build more stuff.
Mm.
The proof of that is if you look at the Southeast, the Sun Belt, they went through a giant construction boom in multifamily,
Yeah.
okay, which has now essentially ended. But I mean, they went through a very big building boom, and rents came down, so things were becoming more affordable. So
Isn't
it's
that
not.
crazy?
I mean,
Yeah.
it's not. It's like if you remember your Econ 101 class,
Oh gosh,
when
I
you
can't
were
believe you said that.
you were hungover because it's Friday morning, you went out Thursday night, and the professor started talking about like supply and demand, the big X. It's pretty easy. If you supply more stuff, the price will
Yes,
come down.
prices come down. Yeah.
So the answer to the affordability crisis, whether it's serving the lowest income people or it's
Mhm.
just serving regular families who just want an average place to live that's of reasonable quality, the answer is to build more stuff. So there, you need economic conditions to be right, but you also need, I don't know if you need regulations to encourage it, but you certainly, it would be nice if regulations got out of the way
Yes.
sometimes. I mean, anybody who's
Exactly.
involved with zoning and that sort of thing at a municipal level knows that. the pain and heartache that can be involved with new development,
Hmm.
especially in places traditionally like California, where these kind of issues are the worst.
Hmm.
So building more stuff will go a long way to solving the problem. But you can't build 6 million new units in a day, so it's going to take a little while.
So at PREA, do you look at supply and demand drivers on geographical regions? And do you help institutions decide, okay, we should look at this region more, we should look at that region more? Is that part of your mission? Is
I
part of the work that you do?
I mean, in the tangentially, I guess occasionally I look at stuff on a regional. I will be careful to say I am not advising pension funds or institutional investors on
Understood.
what to invest in. I just present some facts. It's up to them to take or leave it and decide what it means. Um, and certainly I would never pay attention to me if I was an investor. It's Greg, no.
You're far too
Uh,
harsh. Mm.
yeah, but I mean, if you look again, keeping with this sort of affordable housing story, I
Yeah.
said that there was this, a big jump in renters at the highest incomes, to the lowest end, and in the middle are kind of getting squeezed out. That's at a national level.
Mm.
There's a huge amount of variation metro to metro in that. It is the average story, but if you were a real estate investor or developer, I think that the caveat that you should keep in mind is you're reading the national stories. That does not mean that your local market is following exactly the same dynamics. There are
Mm.
markets where, um, I mean, pretty well across the country, you see this decline in the lowest income renters because there's not enough supply. But in
Mm.
terms of, are high income renters coming into the market in a big way? In some markets it's true, in some markets it's true times 10, in other
Mm.
markets it's not true. So you really have to understand the local dynamics, which is, I think, not surprising in real estate because it is, at the end of the day, a local game.
And is there a tendency, are you seeing for institutional investors to focus on different types of markets, i.e., to move away, for example, from primary to secondary to tertiary? Okay, talk me through that a little.
Yeah, that I mean, and that's a process that's been going on for a number of years, and I think
Mm.
it's accelerated in the last little while. If you go back, I don't know, 20 years, say,
Mm.
um, yeah, 20 years, most institutional investors would say, yeah, we go to New York, we invest in LA and Chicago and Boston and maybe San Francisco, maybe Washington D.C. And that's kind of it. Especially international investors, non-U.S.
Mm.
investors, because if they're coming to a different country, what for them is a different country, they know what New York is, they kind of
Mm.
understand it, they know what L.A. is. If you said, we've got great investments in St. Louis or Atlanta or Austin, an international investor might say, well, I'm not really familiar with those places, so they'd be a little bit shy about getting involved. But it was also true for U.S. institutional investors. That's changed a lot. I mean, there's still interest in the biggest markets
Mm.
because they have a lot of, I mean, obviously a lot of transaction volume, the highest transaction volume, the most assets to look at. But investors have really widened out the net in terms of now they will look at Seattle's and Cleveland's and St. Louis and
Mm.
occasionally at tertiary markets, whether it's Boise or someplace like that. Maybe not Boise. No offense to Boise, but that might be a bit too small. Yeah, but
Mm.
Salt Lake City and those kind of places, there is interest in spreading out the investment net a lot more broadly than there was 20 years ago or even 15 years ago. And I think that's driven by a couple of things. One is people have realized there's attractive investment opportunities there. Like if you come in and look at a high-rise multifamily property in Manhattan, you're not going to get some special deal because no one else has noticed what a good property this is. Everybody has seen it. I mean, you're going to pay full price for that. If you are the only institution or only one of a few institutions investing in properties in Cleveland, maybe you can get a deal. So there's been an attraction in that sense. The other has been the other reason has been the increase in information and technology.
Mm.
Back in the old days, when I had hair, if you wanted information about a market, I mean, you had to go out and dig it up, and that was
Mm.
relatively easy to do in New York. You went around and talked to the different brokers. What are the transactions? What's the pricing? That sort of thing. What's sold? What hasn't? Now You go online, you bring up your database, and you can find out everything you want to know about what's going on in Austin or Dallas or
Mhm.
Salt Lake City or any other market fairly quickly. So the difference in information availability between the biggest markets and the smallest has gotten a lot smaller over the last couple of decades, combined with the fact that people are starting to say, listen, I think there are attractive investment opportunities outside of just the biggest markets. There
That's
was
right.
always an idea. It's a similar kind of theme as affordable housing. There was
Mm.
always an idea in the past that outside of the biggest markets, there was too much risk, right? If you want to
Mhm.
limit risk, you want to stay in New York or LA or Chicago or the big markets. I think, as evidence has come out over the years, people have said, you know what, just because it's the biggest market doesn't mean it has the lowest risk. There are good risk adjusted opportunities in secondary markets and tertiary markets as well.
I know we're coming to your deadline today, so let me just ask you a couple more questions. But you mentioned that you have international investors as well at PREA. Right? It's presumably a fairly significant proportion of your membership. What is the sentiment, overall sentiment at the moment about US real estate investing amongst international investors currently?
You start off with my normal caveats. Every investor is different. So
Yes.
I'll hear all
Okay.
kinds of different opinions out there.
Right.
I think the international community, I don't think this is a necessarily a real estate specific comment, but I think generally speaking, non-US institutional investors are a little cautious on the US at the moment because of the heightened level of risk coming from the environment.
From the
Are there
what environment?
the
What?
regulatory environment?
Yeah. Mm.
So another, are there tariffs or are there not tariffs? Are the tariffs going to be struck down by the court or not struck down by the court? Are they going to be raised? Are they going to be lowered?
Mm.
What's going on with all kinds of other regulations? So there's a little bit of a trepidation. So people are a little bit more cautious. Now, the U.S. is the biggest real estate market in the world by quite a stretch. So you're not going to see people not invest here. I mean, people are still attracted to the fact that it's the biggest market. It has the most liquidity, a lot of attractive opportunities, but certainly compared to past years, there's a little bit more cautiousness, I think, in terms of putting capital to work for the long term. And
Mm.
some of the, if you look at pension funds, the one risk that most pension funds avoid more than all others is headline risk. They do not want to show up in the newspapers. So if you are a pension fund in Canada, and I can say this because I'm Canadian, so I guess I'd get away with it. There's a potential headline risk in putting a big investment into the U.S. Because there's some tension between the two countries right now. So you don't want to show up in the newspapers in Canada as, why did this pension fund just invest $2 billion in affordable housing in the US? Why aren't they investing in affordable housing in Canada? So that kind of puts a damper on things. So there is a
Mm.
little bit of cautiousness with regards to the US from non-US investors. But again, it's the biggest market in the world. It's the most liquid market in the world.
Mm.
Despite the recent uncertainty in terms of the regulatory environment and the economic environment, it's still the most transparent market in the world. It's easy to get information and data on what's going on in the real estate market. So uh, the spigots are not going to get turned off, but people have maybe dialed it back a little bit from what it would have been otherwise.
All right, so let's wrap up with one final question that I know economists absolutely love to answer, and that is interest rates went down yesterday for the first time. What do you think? What's your prognosis for the next 12 months? Let's say seeing us through 2026. Where do you think the market's going to head? How do you think institutional investors are going to adjust their strategies over the next 12 to 14 months or so?
Well, let me start by correcting you because and it's not just you. I think this is what everybody in the markets and in the media says. You said interest rates went down yesterday. No, the Fed funds rate went down. The yield in the 10-year Treasury is actually up
Went
today.
up.
So
Yes.
there's not an
I
interest
stand
rate.
corrected.
Yeah, there's all
Yes.
kinds of interest rates.
All right.
And one of the issues, I think, and the reason people are obsessed by the Fed or overly obsessed is because they subconsciously think there's just an interest rate. And if they lower it, interest rates are down.
Right.
What's the prognosis for the future? Yeah, I don't know. But
Right.
what I
Says it
will
all.
say
Mm.
is that in the economy, to me, if I look at it, and you look at the lack of job growth, inflation continuing to be high, it's an okay shape right now. Economic growth is okay, but not stellar. However, I do think it's at a particularly it's in sort of a fragile state. It's doing okay at the moment, but my fear is it would only take kind of one major thing to kind of knock the apple cart over. A lot of the growth is being driven by investment in AI infrastructure from the biggest tech companies. I think it was 300 or 325 billion dollars in capex from the small number of large tech companies over the last year. That's helping drive the economy. AI euphoria has hit the equity markets. Valuations are way up based on technology that I'm not a Luddite, and I use ChatGPT time, and it's definitely efficiency enhancing. But as of yet, I don't think anybody's figured out how to kind of make money with it. And but maybe they will. But it's at a the economy is at a point overall where things are okay. Inflation is still high. Job market's not great, but they're doing okay. Um, but my fear is it's in a fragile state. And this is the problem that Jerome Powell and the rest of the people at the Fed have is, lowering or raising interest rates a little bit the wrong way. And will that potentially, upset, take that bottom card out of the house of cards? So they're worried about making the wrong move. Hopefully, nothing happens and the fragile economy just becomes less fragile over time, and so we can get back to normal. But that is my fear, is that one wrong move and things could go bad. The equity market seems a little, I'm not going to say overvalued because I don't say those kind of things, but a little overly excited, I think,
Mm.
at the moment. Credit spreads have been going down. So the spread between corporates and treasuries is getting smaller and smaller. So people are thinking
Mm.
less and less about risk, and they're worried less and less about risk. You look at the VIX index; it's down to about 15, which is pretty low. So people seem very relaxed about risk. When I look at the economy, I think there's some risk out there.
Isn't that incredible? You're not the only person to say that. I think this way also, and I get the sense that everybody does. So that's what's so confusing,
Yeah,
actually, is there's something unnatural driving everything. I think we talk about black swan event. And so you've used the idea of house of cards and one card and the whole thing kind of crumbles, which is also good because it's very fragile. But I think of a black signet event, a signet being a young swan, just
so
a
just
little
just
swan.
just
That's
needs
all
to
it
list the
takes.
little
It
one.
doesn't need to be a
That
huge
that's
thing, right?
that's exactly that's a much better way to say what I was trying to
No,
say.
I
Which
actually quite like. I
I
mean, the
don't think
house
it
of.
doesn't take a giant financial crisis, but I think if one of the big tech companies says, "Oh, earnings are way down. This is not working out like we
Mm,
thought," then you'll see the equity market come down. That'll spill over into the bond markets, and you could see things get worse. I'm not predicting. We're not. I'm not talking about 1929 or anything like that. I'm not one of those always a bear market kind of people. But I do think the market is mispricing the risk that is out there right now.
mm. And institutions, they also think this way, you think? Is that part of why they're kind of holding fire?
I mean, everybody's got their own opinion. Obviously, that's
Mm,
why you have a market. But I think because of the degree of uncertainty in the market, in the economy overall, not much about the real estate market, but just the overall economy, there is uncertainty out there, and I think that leads all investors, including institutional investors, and again, not just in real estate, to be somewhat gun shy, a little bit more conservative. And you've got to build a portfolio that is designed to withstand whatever happens in the economy. That's why they employ very smart people with big brains in the risk management departments to say, listen, what can we invest in that no matter what happens, we won't be hit too bad.
Greg MacKinnon, Director of Research, Pension Real Estate Association, PREA. Thank you for joining me again. Super good seeing you.
Oh, always a pleasure, Adam. Thank you.
All right, that was Greg MacKinnon of PREA, Pension Real Estate Association. Greg, thanks so much for joining me again today. I did enjoy our conversation, particularly with this focus on housing. It is I want to say popular topic, but what I should say is a very important topic that really drives so many people's lives in this country today. So hearing your insights is very interesting and I think helps our listeners to understand what they should really be looking at, how they should be focusing, and the kinds of opportunities that may exist that they might not have previously thought about. Uh, and thank you to dear listeners and viewers. Thanks for joining us. Appreciate it. If you've not subscribed to Gower Crowd's newsletter, it's all there. Please go to, I should say, gowercrowd.com, hit the subscribe button, sign up. It's totally free. You can always unsubscribe. And I do try to provide easy to read, but high density, actionable commentary and insights, as well as guidance and ideas for how to optimize your capital formation processes, particularly today in today's challenging environment. Okay, that's it for this episode. Thanks so much for joining me. And until next time, this is Adam Gower signing off.